Chapter 9, Examples for Principles of Accounting. In Chapter 9, we talk about current or short-term liabilities and the various short-term liabilities that a company might have to deal with. The first two examples we're going to look at are with short-term notes payables. So the accounting for a short-term note payable is similar to the notes receivables that we did in Chapter 7 and 8, in that we have an amount of the note, we have a time frame, and we have an interest rate and interest expenses. So first we have borrowed $110,000 cash on May 15th by signing a 60-day 12% note. So the first thing we want to look at is what day does this note mature? So 15 days plus 60 days. We would look at how many days were left in May, and then how many days were in June, and how many days we would go into July. So this note is due on July 14th. Then we're going to prepare the entries to record the note and the payment of the note on maturity. On May 15th, we took the note out. On that day, we received cash, and we would have a note payable liability. We receive cash of $110,000, and we pay a note payable of $110,000. Then on July 14th, we would pay that note. So on July 14th, we would record another journal entry. We would remove that note payable from our liability. We would have an interest expense to pay the 12% interest on the note, and we would pay cash. So our note payable is $110,000. Our interest expense is the amount of the note, $110,000, times our rate, 12%, times the time outstanding, 60 days divided by 360. So 110,000 times 12% times 60 divided by 360. That amount is $2,200. So the total amount of cash we pay for this note is $112,200. Now we're going to look at a note with adjusting entry recording on December 31st. We have a $2,000 note taken out on November 1st. We sign a 90-day 9% note. When does this note mature? When is 90 days after November 1st? So what is our maturity date? So we would have the rest of November, so the 29 days left in November. We would have all of the days in December, 31 days in December. And then we would have however many days in January. So this note is due on January 30th, if you don't include November 1st. If you do include November 1st in your calculation, the note is due on January 29th. On December 31st, we need an adjusting entry for interest. So we're going to record 60 days of interest on December 31st. So for 90 days or 60 days at 9%, 200,000 times 9% times 6 divided by 360 is $3,000. Then the time frame from December 31st to January 30th, when the note is due, we would have additional interest accrued during that time. So 30 days in January we would take 200,000 times 9% times 30 divided by 360, which is $1,500. We record the journal entries related to this note. We took the note out on November 1st. So we received cash, and now we have a liability that is a note payable. Cash of 200,000, and we have a note payable of 200,000. On December 31st, we need to accrue interest in an adjusting entry. So we would have an interest expense and a liability of interest payable. We calculated that amount to be $3,000. On January 30th, we pay this note. We remove the note payable from our liability. We have our interest payable, and we would have an additional interest expense. So our note payable was $200,000. We had interest payable of $3,000, and we had an additional interest expense of $1,500. So all told, on January 30th, we will pay $204,500. Okay. The next thing that we're going to look at in Chapter 9 is payroll taxes and payroll expenses for company. So as an employer, we are required to withhold income taxes from our employees' paychecks and remit them to the agencies, the Social Security, Medicare, unemployment taxes, federal withholding taxes, state withholding taxes. We also have a wide variety of other things that we can take out of paychecks. So if we have health care or retirement benefit contributions, those things would also be taken out of paychecks. In this example, we're going to look just at some general payroll taxes. So we have three different situations, A, B, and C, and we're going to calculate the payroll taxes for each one of these situations. So in the first situation, we have accrued gross pay for the year of $6,400, and our September pay is $800. So we need to calculate our taxes. What we need to know is that there are thresholds at which employees stop paying, or which people stop paying certain taxes. So for the unemployment taxes, FUTA and SUTA, we stop paying after $7,000. Once the employee has earned $7,000, we no longer have to pay those for the year. And then on January 1st, those payments would start over again. For FICA Social Security, those are paid on the first $128,400. After an employee earns $128,400 for the year, they stop paying Social Security until their pay resets at the beginning of the next year. So for this employee, they have not hit $128,400 for the year. So their entire $800 pays Social Security tax. So we take 800 times 6.2% to figure out what our Social Security withholding is. For Medicare, we take our pay of $800 times 1.45%. And that is the rate of Medicare withholding from our paycheck. For the federal unemployment tax, we pay 0.6%, but only up to the first $7,000 paid to the employee. This employee has already earned $6,400. So only $600 of their September pay needs to have employment taxes paid on it. So we would take $600 times 0.6% for our federal unemployment taxes and $600 times 5.4% for our state unemployment taxes. For situation B, this employee has not hit the $7,000 amount or the $128,400 amount. So they're going to pay the full amount of the withholding on all of the taxes. So the $2,100 gets applied to all of them. So 2,100 times 6.2% and 2,100 times 1.45%, 2100 times 0.6%, and 2100 times 5.4%. In situation C, this person had already hit the $7,000 unemployment tax threshold. So there's no unemployment tax on their earnings. They're almost at the $128,400 amount. So we would have to see how much of their pay is subject to FICA Social Security tax. So only $6,300 of that September paycheck is going to be subject to Social Security tax, because then they hit that threshold of $128,400. So we would take $6,300 times 6.2% to determine what their Social Security withholding is. For Medicare, there is no threshold. So all of their earnings times 1.45%. And there's no calculation for unemployment tax because they're well over the $7,000 amount. Now we're going to look at the journal entries. And in this example, we're only going to prepare for situation A. So we also have additional information that their federal income taxes withheld are $80. So we have a salaries expense. We also have the various taxes. So we have FICA, Social Security, and FICA, Medicare, and then we have federal income tax, and the amount that we are paid, salaries payable. Our salaries expense is the amount of our gross pay. So our gross pay is $800. We've already calculated what our FICA Social Security amount and our FICA Medicare amount are. It tells us that our federal income tax withholding is $80. So our net take-home pay for this employee is their gross pay minus the sum of all of their withholding, or $658.80. We also have the payroll tax expense for the employer. So only the employer pays FUTA and SUTA. The employer is also responsible for paying FICA taxes. They pay the same amount as what is withheld from the employee's paycheck. So we've calculated FUTA of $3.60 and SUTA of $32.04. Social Security, $49.60, and Medicare is $11.60. And our payroll tax expense is the total of all of those amounts. And those are the journal entries for payroll. One to record the pay of the employee and all of the withholding from the employee's check. And then the second one is to record the employer's responsibility for various payroll taxes. Our next couple of examples are going to look at estimated warranties. So when we don't know exactly how much a liability is going to be, we need to make an estimate of what it could potentially be. One of those estimates is related to warranty. So when we sell a product that comes with a warranty, we don't know whether or not a customer is going to come back and collect on that warranty for parts or repairs or any various things. So we have to estimate the amount of people that do collect on a warranty. So in this example, we sell copiers. and we sell our copier with 2-year parts warranties. And we expect that 4% of all sales amounts will be collected as warranty costs. This is based on our historical information. So we're going to record our warranty expense with an adjusting entry on December 31st. We want to prepare journal entries to record all transactions mentioned in this paragraph. So first, we sell the copier, August 16th. So we get cash and we have sales revenue. Copier was sold for $6,000. We also have cost of goods sold and inventory in the amount of $4,800. On December 31st, we prepare an adjusting entry for our warranty expense. So we would record warranty expense and estimated warranty liability. So this is the amount that we believe customers are going to come back and collect. So this is 4% of our sales. Our sales were $6,000. So we take 6,000 times 4% and we get an estimate of $240. Then on January 5th, this copier requires repairs. The repairs cost $209 from our repair parts inventory. So on January 5th, we would reduce that estimated warranty liability for $209 that was collected. And then we have parts inventory for $209. We're going to look at 2 more short examples with estimated liabilities. So in the first example, we have accrued vacation benefits, and we're recording our journal entry on December 31st to create a liability for vacation benefits. So we pay our employees 1 day per month of vacation. So we would record a vacation benefits expense and an estimated vacation benefit liability. That amount is $13,000. We also have an estimated warranty liability here, and we're recording the adjusting entry. Our adjusting entry is warranty expense and our estimated warranty liability. So it tells us that we sell 12,000 units that carry a 60-day warranty, and our December sales were $460,000. We expect 10% of our units to need warranty repairs, and we estimate the average repair cost per unit will be $15. So 12% of units is, or 10% of units is 12,000 units times 10%. And then our warranty expense is 10% of units times $15 per unit, or $18,000. In our last example, we talk about contingent liabilities. So contingent liabilities, we either need to record a liability, disclose in the notes to our financial statements, or do nothing. So if we have a contingent liability where either we're being sued and we have a probable belief that it's going to happen, we're pretty sure it's going to happen, and we can reasonably estimate the amount, then we have to record a liability. If we have an amount, but we're not sure it's going to happen, we disclose it in the notes. If we're absolutely certain it's going to happen, but we don't have a note or don't have an amount, we disclose it in our notes. And if we both don't have an amount and aren't sure it's going to happen, then we do nothing. So in these two examples, first, we have guaranteed the $100,000 debt of a supplier. So what we've done is we've signed off and said that if this supplier stops paying their bills, we will pay this $100,000 on their behalf. We don't think that they're going to default, but we would still need to disclose that in notes because we could potentially become liable for that debt by signing a guarantee for it. Second, a disgruntled employee is suing us. Our legal advisors believe we're going to lose the lawsuit, but they don't know exactly how much we're going to pay. Because we don't have a guaranteed amount, this is also a disclosed amount. We would put a note in our financial statements that we are being sued. We're pretty certain we're going to lose, but we're not exactly sure what the liability amount will be for that payout. And that is all of the examples for Chapter 9.